Get to the market texture then and where we are headed. Rakshit Ranjan from Marcellus Investment Managers is with us on the show now. Rakshit, morning. Thank you for joining in. How are you feeling about the markets right now? What's the sentiment gauge and what's the investor appetite? It appears to be very high, but is there some nervousness creeping in?
Well, not so much in the style of investing that we follow, because we don't invest from one political outcome or one budget or one external event outcome to another. Otherwise, yeah, we're feeling quite positive because we can see a lot of opportunities where companies can allocate capital and make bucket loads of returns for investors, and that's where we are orienting our exposures to.
Can you talk about some of the recent changes that you've made to your portfolios?
Yeah, in fact, quite a few. Over the last 12 months, the number of companies or the allocation to companies that we call as sort of enterprising compounders with return on capital employed, not sort of 40-50%, but instead 20 to 30%, and reinvestment rates rather than 50-60%, more like 100% or 90%. So high on reinvestment. And hence high on growth. These kinds of compounding plays have become more than half of the portfolio compared to, say, 10 to 20% that it used to be previously. And largely the reason for that is in the economy, we can see a very clear shift. What has happened is the way the digital and physical infra combined with the integration of the economy through GST, and a structural fall of cost of capital because of physical investments going into financial. What it has done is there are challenger companies, mid-sized corporates, which are taking market share away from the larger incumbents in some areas. So, for instance, in our portfolio, we've got an Astral Poly as a recent investment, and Narayana Hrudayalaya in hospitals. And then you've also got some large companies spreading their wings, allocating capital to build new businesses. So Tube Investments is a case in point. Let's say a Chola expanding the turf, a Trent expanding beyond just apparel and getting into more groceries as well. So yes, those are some of the changes in the portfolio.
Okay, Rakshit, so I was going through your latest update, the July update, the newsletter, the Consistent Compounders, right? And it seems that you guys are now sort of tweaking strategy a little bit to go for companies that are not only allocating capital to their own core business, but also allocating capital to certain unrelated areas. Now, typically that's seen as a red flag by the market. But you seem to be liking, these big giants which are looking at newer business opportunities as well. Just explain that rationale to us. And I think an example that you cited in that newsletter is a Trent and a Tube investment. So just expand on that for the benefit of our viewers.
Yeah, so let me give you an example from, say, 3-4 years ago, so that there's also continuity visible in this change. So when we picked up a Titan 3 or 4 years ago, a Titan was highly energized around non-jewelry businesses, turning around its eyewear business, getting back the energy levels in the watches and wearables business, Tanaira as a sari business. These are not related to jewelry. These are, in some ways, unrelated businesses, right? When a Bajaj Finance was expanding from personal loans to home loans, consumer durables to home loans, that journey was not completely in related businesses. It was a lot of it in unrelated as well. That was not so widely available to us in our coverage universe. The number of Titans and Bajaj Finances of the world were just 2 or 3 options available to us, and hence the portfolio allocation was lower. All that has happened is in the last 2 to 3 years, we've identified several more Titans and Bajaj Finances, and Trent and Tube are 2 such examples that you cited from our newsletter. So in that regard, it's a lot more of what we were doing previously in lower allocations to the portfolio, doing it with greater allocation today. It does rev up the growth engine of these companies because the trade-off is higher reinvestment rates, and maybe 5 to 10% lower return on capital employed compared to, say, an Asian Paints or a Dr. Lal PathLabs, which continues to be in our portfolio, by the way. Just that allocations have been slightly tweaked.
Particularly on Titan, do you think while the diversification strategy is well appreciated into Taneira, etc., watches, eyewear, on their mainstay gold jewellery business, competition is eating into the margins, and the stock has underperformed. It's down 16% from its recent highs, and year to date also it's in the red. Your view on Titan just in the near term as they navigate through these challenges? I know you guys are long-term investors, so you stay put. In fact, you've loaded up and tanked up more. But how should an investor or a retail shareholder understand how Titan is going to deal with these competitive pressures?
Yeah, no, you're right. The near term offers certain headwinds, and about 6 months ago, we more than halved the position size in Titan as a result. The headwinds are, we can see two risks on the horizon, which are more near term. One, as you said, competitive intensity has arisen when the gold price is up. The second is also footfalls of customers. They start dropping for the industry as a whole if gold shoots up by 20 to 30%. If it's a far more gradual increase, footfalls are in fact benefited. But if it's a sudden increase, then customers start delaying their purchases a little bit. So that's the near-term piece. In the medium term, there's a lot of white space that this company is trying to exploit. So, for instance, when you look at the eyewear business, in 90%, 80 to 90% of the industry is below 6,000 rupee ticket size, and Titan is predominantly above that kind of a ticket size. So getting more into mass for eyewear, getting more into mass for wearables is a wide space that this company is going for. Carrot Lane adds a massive muscle to the whole Tanishq piece, and that's a massive growth engine. So from a medium-term perspective, from a long-term perspective, we are quite positive. But yes, as you rightly said, there are a few headwinds. A quarter or two. This is somewhat of a repeat of 2016. I remember in 2013 when a similar story played out. As you said, these things become opportunities to load up more. So at the moment, there's nothing on the long-term horizon that worries us on Titan.
Okay, so Titan over the long term, though you've reduced your holdings to an extent. By the way, the flashes on our screen just alerting us that there is this all-important meeting that's underway between telecom service providers and the telecom minister. This is happening in Delhi. And Ashmit has told us that, among other things, on the agenda is, of course, unsolicited phone calls and communication. That remains a very big issue, pesky calls. And perhaps the next stage of the big rollout beyond 5G, there lies 6G. So those are some of the issues that could be brought up in discussion. We'll touch base with Ashmit. He's right now in the ministry, in the thick of the actions. As soon as he manages to come out, we'll touch base and have a word with him. So a lot of the representatives of the telecom sector attending that meeting. Rakshit, just to round up this conversation, and since we were looking at that list of holdings that you have, of course, one of your long-time holdings has been HDFC Bank, right, and consistent compounders. Now, like with many other parts of the market, this is one stock, one enterprise that has been really testing the market's patience ever since the merger happened. And even, the last quarterly update was not really firing up the charts. We know that. There's this tactical issue, of course, of FPI allocation. But beyond that, what are the expectations you're working with? Will this be the year, the turnaround year for HDFC Bank? What's your base case thesis here?
Well, we hope so. We hope so, although it's very difficult to call a 6-month, 12-month share price trajectory on a stock like that. Yes, I think last 2-3 years, it's been a sequence of slightly uncorrelated events, right from a regulatory ban to a bottom of the NPA cycle for the entire banking system, to this corporate action of the HDFC Limited merger, and then the entire lack of liquidity on the deposit side in the system making it difficult for deposit growth of a bank like this. So all of that is behind us. We believe another quarter or two. None of these factors should have a drag on reported fundamentals. From a long-term perspective, I think the credit aspect, the credit quality aspect, is fairly cyclical. When the sort of credit quality peaks out or NPAs bottom out, that becomes a very attractive point to benefit from investment in a firm like an HDFC Bank, which is pretty much the rationale why we've continued to hold on to our exposure here. And yes, hopeful of better times ahead from an investor perspective on this portfolio holding.
Thank you, Rakshit, for your candid conversation today. With that, we'll slip into a very short break. We'll come back and discuss commodities on the other side. Stay tuned.